All right, so have you ever, I don't know about you, but ever find yourself kind of wishing you could just sit down and grab a coffee with Warren Buffett? Just pick his brain about investing and all that.
Oh, yeah. Who hasn't, right? I mean, the man's a legend.
For real.
Yeah.
So today, that's what we're doing. Well, kind of. We're diving deep into his 1992 letter to Berkshire Hathaway shareholders, like a sneak peek into how he thinks.
Direct line to Buffett wisdom.
Exactly. And trust me, this letter, it does not disappoint.
Let's just say he had a pretty good year.
That's an understatement.
Yeah.
We're talking a 20.3% jump in book value
Right.
in 1 year, on top of an already ridiculous 28-year average of 23.6%.
Yeah.
How is that even possible?
It's honestly wild when you see the actual numbers. They went from $19 a share to $7,745.
I know, right? It sounds fake, but it's totally real.
What's crazy is how simple it sounds when he explains it. Just the earnings from the companies they own, the fact those companies became more valuable themselves, and then just a tiny bit of new stock.
You make it sound so simple.
Well, I mean, it's not magic. It's really about consistency and discipline, which Buffett is all about. He hammers that home in this letter, especially his thing about intrinsic value.
Right. He's not just about getting bigger. It's about owning things that are worth owning.
100%. He wants to own businesses that are built to last, which is why he's so careful about giving up pieces of Berkshire.
You're talking about his no dumb deals policy.
Exactly. He's only issuing shares if he's getting something truly valuable in return, which when you think about it, it's a pretty high bar.
Definitely. And it shows how much he values Berkshire.
Every single share.
Which reminds me of this story Buffett tells about a bank Berkshire had invested in, right? And this bank, they were obsessed with getting bigger.
The classic growth at all costs mentality.
It's like a tale of corporate greed. So they want to buy this smaller bank, but the owner, he's no fool. He wants a deal where his tiny bank is worth twice as much as theirs. Can you imagine?
Talk about a power move. I bet Buffett was cringing as he read that.
Oh, totally. But get this. The deal goes through, somehow. And then the owner, he turns to the bank and says, okay, now that I'm a shareholder, promise me you'll never do anything this dumb again.
Oh, man. Only Buffett could tell a story like that.
It's classic.
Yeah.
But it shows how dangerous it is to just care about size.
Buffett's always saying, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price.
That's where patience comes in, right? Buffett's not chasing the latest hot stock tip. He waits for the right deal.
Speaking of patience, he makes a really important point in this letter. Even with Berkshire's crazy track record, past performance isn't a guarantee.
Right. There's that table he includes comparing Berkshire's performance to the S&P 500.
Up and down, like a roller coaster. Some good years, some not so good years. But the overall trend, definitely up.
Yeah, but I could see how some people might look at that and panic.
That's why he includes it. He's managing expectations, basically saying, don't expect us to hit it out of the park every single year.
Which, honestly, is refreshing.
Yeah.
Especially from someone who, often does hit it out of the park.
Right. But he's also realistic about the challenges, especially as Berkshire keeps growing. He actually says he thinks future S&P returns will be lower.
So it'll be tougher for Berkshire to beat the market by as much as they have in the past.
Maybe. He's not afraid to be honest about those headwinds, but he's still optimistic about the long term.
I think that's what makes him so interesting. He's realistic, but still ambitious.
It's not hype. It's about making smart decisions based on how the business actually works. Like that whole thing with Salomon Brothers.
Oh, right. That was happening around this time, wasn't it? The Treasury bond scandal.
Yeah.
Buffett had to step in as chairman, clean things up. I wonder how he talks about that in the letter.
It's interesting. It gives you a look into his sense of responsibility. This wasn't his mess, but he still felt obligated to fix it.
Yeah, he doesn't spend a ton of time on it, but he mentions it. Says he's happy to be back at Berkshire full time.
Of course.
But he still calls the whole Salomon thing interesting and worthwhile. Classic Buffett.
Total understatement.
But it definitely sounds like it was more than just interesting, right? I mean, he talks about how Salomon's reputation actually improved.
Yeah, and they had record earnings while he was in charge. Pretty good for a company going through a scandal, right?
That's insane.
Exactly.
Yeah.
Shows what he can do under pressure.
It also makes you think about those people he mentions, the ones at Salomon who helped turn things around.
Having a good team is so key.
Right. It's a good reminder that even when everything's a mess, the people matter.
For sure. But okay, so enough about scandals for now, right? Let's get back to Buffett's bread and butter acquisitions.
Because who doesn't love a good business deal?
And he tells it in such an entertaining way. You remember that frog-kissing princess analogy? Oh man, how could I forget? So good. It's like he's saying, hey, I get it. I've made those mistakes too.
Totally. He's describing those managers who are so desperate to make a big splash, they end up buying anything.
Even if it's a bad deal.
Totally. And they just keep doing it, hoping that this time things will be different.
And they usually aren't, are they?
Nope. And it ends up being a costly mistake. But like he says, it's easy to fall into that trap, especially in the business world where everyone's obsessed with growth.
So how'd Buffett escape that trap? How'd he stop kissing frogs?
Well, he talks about how he shifted his thinking. Instead of fair businesses at good prices, he started looking for good businesses at fair prices. Sounds subtle, but it's huge.
So it's not just about getting a bargain. Not exactly. It's about finding those companies that are just exceptional. Strong businesses, great management, the kind of companies that can handle anything.
The ones that can weather any storm.
Exactly. And he uses two great examples in the letter. Central States Indemnity and National Indemnity. Both insurance companies. Both in Omaha.
Of course, they're in Omaha.
Right. Like
Right.
Buffett's keeping it local. But they weren't these flashy, exciting companies.
The kind of businesses people get excited about.
Nope. One was about credit card payments. The other was car insurance.
Not exactly the most glamorous industries.
But they were solid, well-run businesses. And that's what Buffett loves. He calls them companies with excellent economic characteristics.
And I noticed he emphasizes the relationships he had with the people selling these companies too. Bill Kaiser and Jack Ringwalt.
It wasn't just about the numbers, right? These weren't some random companies he was buying. These were people he knew and trusted.
He even quotes one of them in the letter.
Yeah. Jack Ringwalt said, if I don't sell the company, my executor will, and I'd rather pick the home for it.
Wow. That really shows how much trust was involved.
Definitely. Buffett wants to partner with people he respects.
It's about more than just the business deal. It's like he's joining a family.
Totally. And speaking of family, Buffett always wants to be upfront with Berkshire shareholders about how they're doing, which is where look-through earnings comes in.
Okay, so we've talked about intrinsic value, and now it's look-through earnings. What's that all about? It sounds kind of complicated.
It is a little bit, but it's basically Buffett's way of giving a clearer picture of Berkshire's earnings.
So more than just their operating earnings.
Right. It's about the big picture. Think of it like owning a fruit tree. Most accounting, it's only about the fruit you pick and sell that year.
Okay, that makes sense.
But look through earnings, that's like saying, hold on, the tree's still growing, right? Even if we don't pick all the fruit this year, it's still valuable.
Because you'll have more fruit to sell later on.
Exactly. And Buffett says those gains are still important, even if they're not on the books yet.
It's about the future potential, too.
Exactly. And of course, some people might say, okay, but what about right now? This all sounds very long-term focused.
But that classic argument, right? Long-term, we'll all be dead.
Right. But Buffett has an answer for that. He says a true long-term approach, it should actually give you decent results in the short term, too.
Because if it doesn't, what's the point?
Exactly. He uses the example of planting a tree. If you keep planting trees, but they never produce fruit, well, you're doing something wrong.
It's not sustainable.
Yeah.
And he's not afraid to call out those managers who hide behind the long-term focus excuse when their performance is bad.
He actually quotes Alice in Wonderland. He says, even Alice, after listening to the Queen lecture her about jam tomorrow, finally insisted, it must come sometimes to jam today.
He's the best.
It's that perfect mix of funny and wise. But he's making an important point.
Yeah, he can't be all about the future, right? There got to be some wins along the way.
Exactly. It's about having a strategy that works now and in the future.
And that brings us to another big part of Berkshire, insurance.
Right. Because even though Buffett loves his stocks, insurance is huge for them.
In 1992, that was a crazy year for insurance, wasn't it?
To say the least. Hurricane Andrew, remember. One of the worst hurricanes ever. It was a big reminder of how risky the insurance business can be.
Especially when it comes to those huge disasters, those super cat events.
Right. Super catastrophic, like massive hurricanes, earthquakes, those things that cost billions in damage.
And Berkshire, they're one of the big players in that market, aren't they?
They are. Ajit Jain, he runs that whole show. And yeah, they took a hit from Hurricane Andrew. Buffett says they lost $125 million.
Ouch.
But then he points out that all their other super cat stuff, it basically broke even for the year.
So it's all about balancing things out.
Right. Managing risk, diversifying, all of that.
It's gotta be stressful.
It is. It takes a lot of knowledge and experience to navigate that world.
You gotta be able to handle those big losses, too.
Exactly. You need that financial strength. But for Buffett, these big events, They aren't a reason to get out of the insurance game.
They're an opportunity.
Right. A chance to use their skills and resources to do well, even when things are crazy.
It's like they're not just selling insurance, they're selling peace of mind.
Exactly. And speaking of unpredictable things, let's talk about common stocks. Yeah.
Back to Buffett's comfort zone.
Right. As much as he likes insurance, he's always going to love the stock market. And in this letter, he gives us a peek at his portfolio.
And it's a good one. Capital Cities, ABC, Coca-Cola, Freddie Mac, Geico, General Dynamics, Gillette, Guinness, The Washington Post, Wells Fargo.
Those are some big names, and a lot of them are still doing great today. But it shows you what Buffett's looking for. Solid companies, good long-term potential, honest leaders.
And, of course, he wants to buy them at the right price.
Always.
But I love how he explains it all so clearly. No Wall Street jargon. He just talks about businesses and how they work.
He even tackles that whole value versus growth debate.
Which, let's be honest, can be so confusing. Is it value? Is it growth?
Buffett thinks it's a false choice.
Yeah.
He's all about growth, but it has to be the right kind of growth.
Profitable growth.
Yes. Not just growing for the sake of growing. That's how you lose money.
Exactly. And that takes us to one of Buffett's biggest principles. It's all about the discounted future cash flows. Okay, now that one's a mouthful. Discounted future cash flows.
I know, right? It sounds intimidating. But it's actually pretty simple. Imagine you loan a friend $100, and they say they'll pay you back next year. Would you rather have that $100 today or a year from now?
Today, obviously.
Right, and that's what discounted cash flow is all about. Money today is worth more than money tomorrow.
Because you could invest it now and it would be earning more money.
Exactly. So Buffett's looking at businesses, and he's trying to figure out how much cash they'll make in the future. Then he's figuring out what that future cash is worth today.
It's like looking at the sticker price of a car versus how much it'll really cost after interest and everything.
Exactly.
So you got to think about the future value of your money now.
Yes. Don't get caught up in the hype. Focus on what matters long term. That's what Buffett does. He's playing the long game.
He's not trying to get rich quick. He's building something that'll last. And that takes us to another one of his big ideas. Margin of safety.
Ah, yes. The margin of safety. Essential for any investor.
So we've talked about intrinsic value, look-through earnings, now this. What is it? Why does it matter so much to Buffett?
It's all about being prepared. You can't predict the future perfectly, right? Even Buffett knows that.
Right.
So you build in a buffer.
You're expecting the unexpected.
Exactly, because stuff happens. Pandemics, volcanoes, whatever. You can't predict it all.
And those unexpected things can really mess things up if you're not ready.
Exactly. So you got to have a margin of safety. It's the difference between feeling comfortable and panicking when things go wrong.
It's like packing an extra suitcase, just in case.
Right. Better safe than sorry. And in investing, that extra suitcase can make all the difference.
So Buffett's not trying to swing for the fences every time, right?
Yeah.
He's happy with those base hits because they add up over time.
Exactly. Slow and steady wins the race.
It's about building wealth over the long term, which is something you see throughout this whole letter. It's all about the long game.
Totally. And you can really feel that in this letter. He's not worried about the next few months. He's thinking years, decades even. The next generation in Berkshire.
That's pretty rare these days, isn't it? Most people just want results now.
It's refreshing, right? But that's Buffett, always thinking ahead. It's part of what makes him so interesting to listen to.
He's not just an investor, it's bigger than that. He's a teacher, a philosopher.
Right. He's got all this wisdom, and he's sharing it with everyone.
And that's what we're trying to do here, too. Take his knowledge and see how it applies to our lives, whether we're expert investors or just starting out.
Because the best part is, it's not about some secret formula, right? It's stuff anyone can learn. Patience, discipline, focusing on what things are actually worth.
It's about owning good businesses and seeing the bigger picture, the whole economy.
Exactly. Think like you own the place. Don't get caught up in the day-to-day ups and downs.
And you got to have the guts to go against the grain sometimes, too. Remember Buffett's line, be fearful when others are greedy and greedy when others are fearful.
Classic. It's about trusting your gut, even when everyone else is freaking out.
So as we wrap up here, I'm curious, what really stuck with you from this letter? What are you going to take away from all this?
It's that reminder that investing, it's simple, but it ain't easy. It takes work, you got to be consistent and patient. But if you do it right...
the rewards are huge.
Exactly.
And remember, you don't have to be Warren Buffett to be good at this. Just got to keep learning from the best.
And who knows, maybe someday someone will be studying your investment letter.
Now that's a goal. Thanks for joining us for this deep dive. Until next time, happy investing, everyone.